If you're looking for three super smart tips on dividend investing plus some passive income secrets, then you're in the right place. I'm about to reveal why 4% rule is the strong your finance. Have you ever thought, how much money do you need to retire interest only? We crunched the numbers and we can tell you how much you need to save to get $40,000 every year in retirement without taking a bite out of your principal. And we did the same calculation just in case you want to get $100,000 every year. I understand that finding good stocks who pays increasing dividends over time can be very difficult and confusing at times. But don't worry because today I'm going to share with you two stocks to buy now. Actually, it's one right and one stock, both with increasing dividends over 25 years. Make sure to watch this video until the end because it's one of the most amazing stock buy opportunities I've ever seen. Welcome to Yahoo Sun channel. Subscribe and turn on notifications so you don't miss more videos helping you on your finance journey in the stock market. It's been more than 25 years since Bill Bengen created the so-called 4% rule. That's the principle that if you want to make sure your retirement savings last at least as long as you do, you should budget to spend no more than 4% of the balance in the first year and then adjust the amount each year in line with inflation. So, how he came up with this number? Through experiment with portfolios of different allocations, he just took the withdrawal rate down until he got one that lasted, a portfolio that lasted 30 years. And at that time, he was only working with two asset classes, basically large company stocks and treasury notes. And he got a number of 4.15%. The withdrawal rate was the same over a very wide range of stock allocation between 45% and 75%. It was about the same. So at that point, it didn't appear to make much difference what you choose. But he knew that a very heavy stock allocation was bad and a very low stock allocation was bad. So he came up with a number, and of course, that number has haunted him for years since then because one number cannot represent the experience of so many different retirees. There's just too many dimensions to the problem to have a one number solution. Not only is he no longer sticking to 4%, he says that that number was always treated too simplistically. He says it was historically just the worst case scenario that was based on someone who retired at the worst moment he could find in modern times, October 1968, just as the stock market peaked and runaway inflation was beginning. Someone who retired at that moment had to endure a bear market for US stocks that would last 14 years and skyrocketing inflation that crushed the purchasing power of their savings and fed their bonds into the shredder. Someone retiring then would still have been okay for 30 years if they withdrew no more than 4%. Originally, he was just working with two asset classes. And then in 2005, he introduced the small cap stocks, US small cap stocks, which reduced everything. His calculations, incidentally, are all based on a conservative retirement portfolio, where you keep 30% of your money in the S&P 500 index, 20% in the US small caps, such as the S&P Cap 600 index, and 50% in intermediate US Treasury bonds. He didn't have a perfect correlation with the large cap, so that juiced it from 4.15% to almost 4.5%. He uses them as a proxy for a wide variety of asset classes, international stocks, REITs, and so on.
because they're so powerful in terms of generating high returns. And that's when he came up with that number. But he adds, at other points in history, when inflation was low and stocks and bonds were cheap, a new retiree could have withdrawn much more and done okay. Historically, he says, the average safe withdrawal rate has turned out to be about 7%, and at points it has reached as high as 13%. Of course, retirees who are that fortunate wouldn't have known that until afterward. Now we criticize the 4% rule, saying that it's too high. Now returns have been weaker, and we say 4% sounds too high. Inflation is equally important as returns in this analysis, and that when you have a low inflation environment, your withdrawals are also going up much more slowly. So there's an offset to the lower returns that you can't ignore. Now we're sitting at inflation that the Fed is just praying it doesn't go negative at this point. So we're hovering at the zero bound. When we start looking at things like real rates of return after inflation, they're not nearly. We may be in a somewhat low return environment, but they're not nearly as low a return as sometimes we make it out to be because we look at the nominal and forget the real. All driven by this combination of low yields, which will drive people towards more stocks but low inflation, which actually gives them comfort that they don't need to be hanging out down like 2% or 3% withdrawal rates. 4% is enough. 5% is still reasonable because at the end of the day, when inflation is this low and you're only spending a few percent, you actually don't need a huge amount of growth in your portfolio. Have you ever thought how much money you need to retire interest only? An interest only retirement plan removes one of the biggest fears about life after leaving your job. Will your money outlast you? Because if you can save enough now, you can fund your retirement by living off your returns without ever touching your nest egg. We crunched the numbers, and we can tell you how much you need to save to get $40,000 every year in retirement without taking a bite out of your principal. First, some ground rules. The numbers assume you will retire at 65 years old and have no money in savings now. For investing, we assume an annual 6% return when you are saving and a more conservative 3% rate for your interest-only retirement. We don't factor in inflation, taxes, or any additional income you may get from Social Security and your 401k. To get $40,000 a year in interest only, you will need to save more than $1.3 million at the time you retire at age 60. That means a person starting at 25 will need to save $670 a month to get $40,000 a year at age 65. Starting at 30, a person will need to save $936 a month to get $40,000 a year at age 65, living off their returns. Starting at 40, that same person will need to save $1,924 a month to get $40,000 a year. Starting at 40, the same person will need to save $1,924 a month to get $40,000 a year at age 65. As you can see, the earlier you start, the better because of the compound interest. You not only earn money on your investments made through your savings, but you get returns on your returns. If, however, you want to retire with nothing to worry about and have a nice life, you should think about the $100,000 a year. We crunched the numbers and tell you how much you need to save to get $100,000 every year in retirement. without taking a bite out of your pizza. To get $100,000 a year interest only, you need to save about $1,300,000 by the time you retire at age 65. That means a person starting at 25 will need to save $1,674 a month to get $100,000 a year at age 60. Starting at 30, a person will need to save $2,340 a month to get $100,000 a year at age 65, living off their returns. Starting at 40, that same person will need to save $4,810 a month to get $100,000 a year at age 65. Now, let's talk about an awesome ride. Realty Income is a real estate investment trust that owns, develops, manages, leases, and acquires primarily retail properties. The trust niche within the retail right space is a single-tenant properties, most with triple net leases under which the tenant assumes financial responsibility for real estate taxes, insurance, and maintenance costs. We calculate the intrinsic value, also known as fair value of this right, as $60. So if the price in the moment you're watching this video is below $60, then you have a buy signal according to fundamental analysis. As of June 30th, 2020, Realty Income owned a portfolio of over 6,500 properties located in 49 U.S. states, Puerto Rico, and the United Kingdom. The trust's properties are leased to over 600 different commercial tenants conducting business in 50 separate industries. At June 30, 2020, the trust derived about 84% of its rental revenues from retail properties, 11% from industrial properties, 3% from offices, and 2% from agriculture. Realty Income was founded in 1969 and completed its initial public offering in October 1994. Realty Income's revenue growth has slightly outpaced the subsector average of 11.4%. Since the same quarter 1 year prior, revenues rose by 13.4%. This growth in revenue does not appear to have trickled down to the company's bottom line, displaying stagnant earnings per share. The debt-to-equity ratio is somewhat low, currently at 0.77, and is less than that of the subsector average, implying that there has been a relatively successful effort in the management of debt levels. 49.68% is the gross profit margin for Realty Income, which we consider to be strong. It has increased from the same quarter the previous year. Along with this, the net profit margin of 26% is above that of the subsector average. Net income growth from the same quarter 1 year ago has significantly exceeded that of the S&P 500 and the real estate subsector. The net income increased by 13.3% when compared to the same quarter 1 year prior, going from $95.19 million to $107.82 million. Realty Income Corp reported flat earnings per share in the most recent quarter. During the past fiscal year, Realty Income Corp increased its bottom line by earning $1.39 versus $1.26 in the prior year. This stock's PE ratio indicates a significant discount compared to an average of 51.24 for the real estate subsector and a premium compared to the S&P 500 average of 34.8. For additional comparison, its price-to-book ratio of 2 indicates a significant discount versus the S&P 500 average of 3.73%. For additional comparison, its price-to-book ratio of 2 indicates a significant discount versus the S&P 500 average of 3.73 and a significant discount versus the sector average of 5.8%. For additional comparison, its price-to-book ratio of 2 indicates a significant discount versus the S&P 500 average of 3.73 and a significant discount versus the subsector average of 5.84. The price-to-sales ratio is well above both the S&P 500 average and the subsector average, indicating a premium. Upon assessment of these and other key valuation criteria, Realty Income Corp moves to trade at a discount to investment alternatives. Now, one of the most amazing stock buy opportunities I've ever seen. AT&T provides communications and digital entertainment services in the US and internationally. These services and products that the company offers vary by market and include wireless communications, local exchange services, long-distance services, data, broadband and internet services, video services, telecommunications equipment, managed networking, and wholesale services. We calculate the intrinsic value, also known as fair value of this stock, as $35.50. So, if the price in the moment you're watching this video is below $35.50, then you have a buy signal according to fundamental analysis. Net operating cash flow has slightly increased to $12,123,000 or 6.44% when compared to the same quarter last year. The firm also exceeded the subsector average cash flow growth rate of 11.32%. The gross profit margin for AT&T is rather high. Currently, it is at 53.14%. Regardless of AT&T's high profit margin, it has managed to decrease from the same period last year. Despite the mixed results of the gross profit margin, a net profit margin of 6.65% trailed the subsector average. The company's current return on equity has slightly decreased from the same quarter 1 year prior. This implies a minor weakness in the organization. In comparison to the other companies in the telecommunications subsector and the overall market, AT&T's return on equity is significantly below that of the subsector average and is below that of the S&P 500. Looking at the price performance of AT&T's shares over the past 12 months, there is not much good news to report. The stock is down 25.92%. And it has underperformed the S&P 500 index. In addition, the company's earnings per share are lower than today. In addition, the company's earnings per share are lower today than the year earlier quarter. Despite the heavy decline in its share price, this stock is still more expensive when compared to its current earnings than most other companies in its subsector. Subscribe and turn on notifications so you don't miss more videos helping you on your finance journey in the stock market and more. If you liked this video, please smash the like button and I'll see you in the next video. Take care.